Welcome back to the Reagan RedZone. I'm your host, Webb Milward. Joining me today from the Reagan team, Kevin Stipe and Brian Deitz. Gentlemen, welcome back to the RedZone.
Webb, good morning.
Yeah, excited
Glad
to have
be
you
here.
guys here. Guys, we are going to dive right in and talk about an event that happened recently, February 9th, 2026, an event and a day known as Black Monday. A specific event hit the stock market with the destructive force of a Sharknado. It wasn't related to earnings, wasn't related to macroeconomic factors or geopolitical and global risks. This was due to AI-driven disruption triggered by Insurify. Now, Insurify is an insurance comparison marketplace. They launched a ChatGPT-based insurance comparison app that allows users to get real-time quotes, compare policies, and shop for insurance directly inside of an AI conversation. Now, the immediate market reaction was severe and not good for public brokers. Major broker stocks among the big five, Marsh, Aon, Gallagher, Willis, Brown & Brown, were all down somewhere between 7 and 12%. The S&P also fell 3 points, which was its largest decline in a few months. Now, at the same time, other AI insurance tools also went live inside of ChatGPT, reinforcing the idea that shopping for insurance could potentially move to AI interfaces. Now, move up into March. In March, a Bank of America global research report estimated that $15 billion, billion with a B, of insurance commissions are at risk, especially low complexity tasks within agent and broker operations. Furthermore, 2026 has also been described as the turning point where AI moves from experimentation to live practical usage, to a world where AI is financially material. Now, this is all again raising threats of disintermediation for brokers. We've seen this before, but what is new about today? So there's a lot to unpack here, guys, with that kind of preamble. I'm excited to hear your thoughts. First question goes to you, Kevin. Is this doomsday or is this an overreaction? Are the public brokers being treated fairly? And finally, do you need a traditional broker anymore to buy insurance, or can you simply ask AI?
Well, that's an interesting sequence of questions. Clearly, this was an overreaction. It was funny on that day. We're watching this unfold, and in the days that followed, people are like, wait a minute, this is a personal auto comparison app, and we're punishing the global brokers that do the most sophisticated risk management on the planet for a personal auto app? You've got to be kidding me. And so there was this like shoot first, ask questions later reaction that trickled through the marketplace that day. And we've seen a rebound of the public broker stocks since then. 4 of the 5 have actually stayed level or rallied from that, even while the market, because of the Iran conflict, has gone down. So there's been a recovery. And I think what's interesting is if you look at this was not at all unprecedented within the stock market. Like every industry that is in professional services has had its crisis moment over the last 6 months. You've seen that in legal, you've seen it in accounting, you've seen it in software as a service. All of these different industries have had a moment where, say, Anthropic would announce, they've created a product to do legal analysis. And all of a sudden, what happened in our industry happens in that particular industry. And actually, the setbacks in other industries, like the legal industry, was actually more severe and longer lasting than what we felt. And I think what happened with our industry, and that B of A report was part of this, is let's assess who is actually going to be affected by this the most, and then let's make our bets in their future on that. There's this Benjamin Graham, a famous stock analyst, said, in the short run, the stock market is a voting machine. Over the long run, the stock market is a weighing machine. And so you had this kind of panic, and this happens in markets all the time, but it has settled down. And I think now we're seeing investors say, okay, The publicly traded brokers, as we know them, are relatively insulated from this, and those stocks have come back relative to the overall marketplace.
Yeah, I'm not sure I understand the voting machine, weighing machine analogy perfectly, Kevin, but I'll just say this. To me, this is such a ridiculous overreaction, and an assessment of the market position of large brokers in general that's just wholly inaccurate. And the thought that the largest brokers and the folks with the most retail broker relationships with clients are going to be displaced here, I just think it's crazy. And if you go back to, let's go back to the last revolutionary technology that we had. Let's go back 25 years or 30 years and the internet is born. If you look back at the history of the internet, it was a tool that enabled smaller companies, nimble companies to access customers. But it did not wholly eliminate the large established players, and in fact also enhanced their market positions and ability to reach customers. If you look at who sells sporting goods online, it's Dick's Sporting Goods, who has a bunch of retail stores also and is an established player. McKinsey did a study about how the internet actually helped entrepreneurs and smaller players, but it helped the people with market share. And so I think this is going to be the same thing. And if you look at that Insurify announcement, Insurify built this, I believe, with the help of a third party through a Chat GPT interface. You're telling me that Gallagher can't do this? That Marsh can't do this? I think that it's crazy to assume that Insurify, which is a great, fast-growing firm, they don't have the product knowledge, the relationship knowledge that these larger brokers have, and there's nothing that prohibits these larger brokers from establishing some of these same kinds of tools. And we will see that happen. These AI interfaces, if this becomes the way that insurance is sold, there's no reason why Willis or whoever else that wants to sell personalized insurance or small commercial insurance can't do these same things. So I think it's a crazy overreaction, Webb, to a kind of minor announcement. And by the way, this is already a segment of the market that these large brokers don't service anyway, and has already been commoditized in some ways. I think I can't understand it. I think it's crazy.
Well, there's one more part of this that I think is really interesting, and a lesson that has come out of this and other industries, and that is when the bloodbath occurs, you have to proactively demonstrate to the market how far away from that rational fears your business is. And LexisNexis, a legal data and analysis firm, had their own Black Monday like a week before ours, and their value went down more than any of the brokers. And since then, they've experienced their own rally, and they did that by establishing that their position in the market was an essential one. Their position within their clients' businesses was an essential one. And they had to demonstrate to the market that they can embed AI and are committed to embedding AI rather than being replaced by it. And
yes,
it's no coincidence that that playbook was then followed by Hub in our industry 2 weeks after Black Monday. Hub kind of took the unusual step of doing a press release that basically highlighted their partnership with Anthropic, the one that created so much trouble in some of the other industries. And they talked about how long they'd been using AI, the advantages that they were getting out of it, the savings, the client satisfaction, and all these other things. So I think what you've got to do is demonstrate to the marketplace that you are leaning into AI, and that helps people get an understanding that you're not going to be replaced by
yes, I think this is exactly my point, Kevin, because if you think about, and it comes down to whether you think that AI is so revolutionary that it is more important itself than the existing sort of industry knowledge and industry capabilities, or whether you think that AI is just going to be an enhancement to industry knowledge, industry capabilities. And if you believe it's the latter, then no one has more product knowledge, data on claims, policies, client relationships than the large brokers, than the publicly traded brokers, private equity backed brokers, our large regional clients. They have that industry knowledge. And so by default, they've got the most to gain from leveraging AI to accelerate and accentuate the power of that knowledge. And I just think in the long run, that's where we end up.
Well, I'll just add one more thing to that, because I don't think it's enough to just say you're saving money by using AI. You're getting quantum leaps in productivity. I think one of the things that we've learned in observing the market over the last 20 years is the market is super, super sensitive to expectations of future growth. That's the issue all the time. And I think right now the marketplace is trying to assess, are the brokers actually going to see their growth slowed by some AI enabled company taking over market share? And so here's what I would say. When we talk about AI and some of the fantasies about what it could do in the brokerage universe, gosh, could we see producers routinely with $5 and $10 million books? Could we see service people able to handle millions of dollars worth of revenue effectively enabled by AI? And I'm going to say that is not the end game. The end game here is for brokers to take the productivity savings, whatever they can squeeze from AI, redeploy that into ways that they can grow their business. And that may be growth the traditional way, it may be growth enabled by AI, but you've got to be able to make the bridge between what AI is going to do from a productivity standpoint and how that's going to enable better future growth. And that's the way investors are going to look at stocks in this industry and say, we're excited again.
Yeah, just last comment for me. Interestingly, over the last few weeks, with some of the large brokers that we've talked to, they are not getting rid of all the headcount in the lower levels of their organizations. They're actually just matching them with AI to do higher level tasks. So they're not saying, oh, we don't need these people anymore because AI can do this job now. They're just giving AI to those people to do higher level tasks. So I think it's an interesting playbook to see how this evolves. But good start, guys. Let's move into topic 2 here. Regardless of AI and Insurify, what do you make of what's going on with public broker valuations, public broker multiples right now as we sit here on April 1st?
Yeah, the public brokers, regardless of AI, are down and have been on sort of a downward slide for the better part of a year now. And that stock price decline that we've witnessed in the public markets hasn't been driven by AI. It's been driven by, Kevin, what you were just talking about. It's been driven by growth. The earnings releases that public brokers went through in Q2, Q3, Q4 weren't great, and growth expectations came down significantly. Part of it is the revenue recognition methodology in ASC 606 that brokers employ tends to accelerate changes in the market. And so public brokers versus private brokers are going to experience a decline in growth fastest. And they're also exposed to larger accounts, which have been relatively softer than midsize and small P&C accounts. And so public broker stocks have started sliding well before Black Monday. Benjamin, if you'll pull up the chart on public broker multiples, what this has done is it's really affected the valuation multiples for, we've got here the kind of 5 traditional public brokers: Marsh, Gallagher, Brown & Brown, Aon, Willis. And by our estimates, these guys are trading at around 12.5 times EBITDA right now. And if you look back at that valuation relative to where we've been for the past 7 or 8 years, it's a pretty steep discount, almost a 30% discount from the peak, and the lowest valuation multiple that we've seen in 10 years. And this is kind of interesting, and this is not all AI based. This is based on, a lot of this is based on the market's reaction to performance and a market that's not quite as hard as it used to be. And so Kevin, what do you think? Is this a new normal or is this a temporary dip?
No, I think you seem to not understand what Benjamin Graham had said. So let me spell it out a little bit better. The voting public reacts and overreacts to things, and that's what happens in the stock market. And so you see these swings. Over the long run, nobody really argues that a stock isn't valued properly if you can zoom out and take a long enough horizon. And so I think right now we've had a tough 12 months of decelerating expectations of future growth. You know, the soft market is clearly the biggest issue here. And we've had this kind of overreaction by people wanting to get out of these stocks. And then, and then you have the Black Monday thing coming on the heels of an already 20 to 30% decline in these stocks. And it's just this collection of bad news. And then you get the Iran conflict, and people are just anxious right now. But I'd say, I mean, and you don't have to put the chart back up, but you made the important point. We're at the lowest EBITDA multiple in 12 years, and one that's like 30% down from where it was just a year ago. I think it's a buy right now. I think as investor sentiment kind of realizes that the public brokers are here to stay, and they're here to stay for some important reasons that are like really they're systemic kind of reasons. There's two things I would point to. One, the public brokers and insurance brokers in general occupy this like beachfront real estate position in the value chain of insurance. And what I mean by that is they are face to face with the customer. That is the best place in any value chain to be, because you get real-time feedback. You've got a relationship with the buyer. You actually, if you're really good at what you do, you can actually be involved in their decision making. You are the hardest part of that entire value chain to displace. And so what I think is going to reemerge is this admiration for the position that the broker fulfills in the value chain, and that's going to reemerge as a very high multiple relative to where we are today. The other thing I'd say is, if you zoom out a little bit and just look at what clients need, there's this idea that they can just somehow go into Copilot and get their insurance solutions figured out. It's like, businesses today are under more pressure than they've ever been to be really focused on what they are providing to a customer. And the thought that a business that is lean and mean has additional resources to spend more time investigating insurance programs and solutions, they need outside advisors. Their businesses are far more complex today than they were a decade ago. If you take a 50-employee contractor, for example, that is a complex business. There's new risks, there's new complexities, there's new regulatory environment that they face. They need help. The role of the broker is expanding, not shrinking. And so an AI-enabled broker, public broker, private broker, I think the future is very strong.
Okay, but I don't necessarily disagree with you about the long-term value of the broker, but playing devil's advocate here and thinking about your point earlier, which I think is correct, that the market wants growth. The growth right now is just bad. I mean, Brown and Brown at negative 2.8% in Q4, Baldwin at 3%, Marsh at 4%. Growth expectations in 2026, the guidance is not much better. Announcements this morning that April 1 reinsurance treaties are down 15%, 20%. So I get the theoretical positioning about beachfront real estate and all of that good stuff, and I get the long-term buy, but I mean, where are we going to get the growth now that's gonna create a turnaround in these valuations?
Well, I think it's going to come from two key traditional sources. One is a resumption of organic growth after the worst part of the cycle is complete, and that may take 12 or 24 months to shake itself out. And then the other is inorganic growth, and there continues to be a strong supply of insurance agents and brokers out there for the right buyers to actually buy. And so
Yeah.
I think we'll continue to see a solid kind of dual major form of growth for brokers. Remember, these multiples end up being exaggerated at the top and the bottom. And so I think we'll see a resumption of probably 14, 15, 16 times EBITDA valuation levels for public brokers within a relatively short period of time.
Yeah, I think that too. I just think the question is when. And I think another thing that could help the public brokers is just sort of valuation and attractiveness by comparison. The Q4 revisions to GDP weren't great, like 0.7%. And if we go to a market that starts to look at all like a recession, we know that public broker stocks and insurance distribution in general performs well in those environments. And there's certainly some global turmoil right now as well. There could be just sort of a flight to safety for these equities, which we've certainly seen before.
Well, and I think we've seen in the last week, actually.
Yeah, maybe that's right. And so I think I'm with you. Man, that the immediate news around growth is not telling a good story.
Yeah.
What about privately held brokers, guys? Let's pivot to kind of our core client and where we play in the marketplace. Are they experiencing some of this same pattern or a different environment for them?
Yeah. We do a bunch of these valuations, probably, I don't know, 75 of these a year. And a key part of the valuation process is we just sit down with management teams and talk through what's going on. And we are just knee deep in those conversations right now. There are certainly some common themes. And one of them that dovetails with what we're seeing from the public brokers is that growth expectations of privately held brokers are coming down. A key part of our valuation practice is that discounted cash flow, where we're projecting forward revenue growth and EBITDA growth for 5 years. And if you look at the growth rates that our clients were projecting a year ago versus the growth rates that they're projecting now, they are projecting slower growth now. They are lowering their expectations this year versus last for the next 5 years. And certainly that's due to market concerns and P&C pricing. That has isolated as a variable, that has an effect on valuations. Kevin, what else are you seeing?
Well, since you love this analogy so much, I'll use it one more time.
Benjamin Graham, one more time. Here we go.
Private company valuation is a weighing exercise rather than a voting exercise. And so we're very calmly looking at all kinds of financial, operational, and forecasted results for a business and then putting a value on that. And, I would say when we think about the common themes of what we're hearing, what's interesting right now is that there's been this theme over the last 2, 3, 4, 5 years of we'll be talking to a management team and they'll say, hey, we had a great new business year. We had a record new business year. We didn't grow as fast as we thought we were going to. We had a retention issue this year. And you say, well, what happened? They said, 2 of our largest accounts sold to private equity and they moved to a different broker that was the one that was, that was kind of selected for the PE sponsor. And so we lost those accounts and they came to us and said, we love you guys. You didn't do anything wrong, but that's what happened. And so you've got the PE faction that is doing acquisitions. And then I think beyond that, you've just got businesses more under pressure today. The insurance buyers are more under pressure than they've been. And so there's a little bit less loyalty there. They're a little bit more prone to the temptation of the kind of the shiny object that can give them a quick fix and something. And so I think actually if we were able, I wish we could do this, if we could measure kind of the industry average retention level on a per client basis, I think it's down like 2 or 3 points, which may not sound like a huge amount, but when you put that up against the new business and the cycle that's going on in terms of hard market, soft market, I think it's really exaggerating the growth challenges that both public and private brokers are facing right now. And
Yeah.
it's incredible how common that story is.
Agreed. We are hearing that a lot. Hey, look, whatever it is, we had 3 of our top 20 clients sell, and we lost that business. But what's interesting about this is that if you believe that client retention is down 2 or so points across the board, and you believe that our industry is almost a zero-sum game where, if that client leaves me, they go to another broker, that then theoretically new business should be up 2 points across the board, and it's not. New business in our industry just kind of stays consistent, and so it's almost like we've got this retention hole, which I agree that we have, but not necessarily a new business acceleration.
Yeah, I know one of the things that we'll all be watching really closely is the Q1 results and performance of privately held brokers. And that comes to us in the way of our growth and profitability survey, which for everyone listening launches on Monday, April 6th, coming up here. And it's a fascinating look at the performance of 150 to 200 of the top privately held firms in terms of everything you're talking about: organic growth, new business, sales velocity, profitability. I know you'll both be excited to see those results, but any kind of parting shots or comments about what to expect there?
Yeah, let me just close here, because I'm afraid if we let Kevin close, we'll get one more Bell analogy here, and it'll just ruin the whole podcast.
I can't wait.
There is not a perfect correlation, and in fact, there's often not much of a correlation at all between public broker valuations and private broker valuations. And what we're seeing in the market for publicly traded brokers is a valuation decline. We don't necessarily expect that in our portfolio of privately held clients, because those valuations wind up being much more correlated to agency performance than they do to the whims of investors. And the other thing that's happening is that most of our clients, our valuation clients, and really most employee-owned brokers are pass-through entities. They're S corps, they're LLCs, which means they're paying taxes at an individual level and not at a corporate level. And in the I don't know the official name, but the One Big Beautiful bill that got passed last year, that cemented the QBiz pass-through income deductions, which have effectively lowered tax rates in our valuation clients almost across the board, which is going to be a decent boost to valuations this year, which will go a long way toward kind of counteracting any projected earnings or revenue growth. There's some good news right now in valuations for privately held clients, even if there's not a lot of good news in the valuations for publicly held brokers.
Well, and I'll give what I'll consider to be 2 pieces of good news. One is that if we do have public broker valuations coming down, and if they stay down for any length of time, then it's going to make it harder for them to really pay up on an acquisition. And a lot of our privately held clients are competing for those acquisitions. And for years, if you look at your chart, we're wildly priced out of the market for acquisitions. And now we have a little bit of that public broker premium being squeezed out. And now I think privately held firms, when they're competing for an M&A opportunity they want, they can be relatively more competitive than they've been in recent times. And, it was a while ago, but in 2010, employee-owned brokers, did more deals than any other player in the buying community. And then soon after that, they were passed by private equity, and private equity has really dominated that. But my point would be that I would see private brokers with a better opportunity in front of them as buyers over the next 12, 24 months than they've perhaps had in a while. And I would agree, Brian, for the reasons that you said and the reason that we don't have a lot of volatility. Private broker valuations will be up for this past year and will probably be up again this year. And if you look back over the long horizon, over like a 35-year period, we've measured this, private brokers have appreciated at an 11% per year growth rate in their valuation. And that has far exceeded the S&P 500 over that time. And we don't see any reason why that should change over the next 5 or 10 years for those private brokers that are leaning into AI adoption. They're leaning into technology. They're doing the things that you need to do to continue to grow. I think the prospects for them are great.
Well said. Totally agree.
Nice. Thank you, guys. Great discussion today, and appreciate you guys being in the red zone. And again, for our listeners, look out for the launch of our GPS survey on Monday, and hope everyone will participate. Look forward to seeing you again. Thanks, guys.
All right.
Thanks, Webb.
Webb. See you.